Hey guys, it's Canadian Kyle here at the Wealth Holders Podcast, and today I'm joined with Fred Bell. He's the CEO of Elemental Royalties, ticker symbol ELE on the TSXV and ELEMF on the OTCQX. Fred, how are you doing today, and where are you calling in from?
Very good, thanks, Canadian Kyle. And maybe I should change mine to British Fred. Calling in from London, and I think hoping some point later this year to actually get over to Canada and meet all the Canadians and a lot of our shareholders out there.
Yeah, how's it doing meetings from there? It's quite the time difference, especially the people in Vancouver. I'm in Ontario, but it's even bigger time difference for them.
Yes, we like to joke that we're a sort of 24-hour company because we go to bed and it's middle of sort of Vancouver's sort of late afternoon evening, and then we wake up in Australia is sort of their late afternoon evening. So we've got people in Melbourne and in Vancouver, so we literally straddle it. So as far as working hours go, um, it's good that we enjoy our work,
Hmm.
because I think if we didn't, there would be serious issues.
Yeah. Well, I appreciate your flexibility with me. I work a 9 to 5 and you're talking to me at like 9 p.m. your time. So I appreciate it. I like kicking off the podcast though by asking my guests what they're doing when they're my age. So I'm 25. What were you doing from 20 to 25 years old?
So I actually graduated with a degree in history, which is not the classical entry route into mining,
No.
but it is quite common in the UK, I suppose, that you do a almost non-career degree. So a lot of people do history, English, philosophy, classics, whereas my older sister actually went to university in the States, and I know it's a lot more common there. People do economics degree, a business degree, and that kind of thing. So I did history, not any intention to actually go into history. And I probably thought I'd end up in the city in London. And my class graduated in 2009. And it was, GFC.
Yeah.
I always remember one of my friends who had done an internship at one of the investment banks, and he had been offered a job when we graduated, and of course it got pulled straight away when the markets collapsed. So
Right.
2009 was actually wasn't a great time probably to graduate for a lot of people, because it was very tough. But I got a work experience internship with um, a sort of stockbroker in London, NCB, which was bought by Investec, and I ended up working with a real estate analyst there, and it was really good experience. And I probably thought I would end up in a sort of more conventional route, but I had in my time at university done some work experience with junior AIM listed exploration development companies in the mining space, and through that I got a call, and I always remember taking it in the office, and I going on the fire exit stairwell and taking it, and they sort of said this Australian listed company, it's just relisted.
Hmm.
One of the guys who was behind it is not very well, and he needs to step away for a while, and we need someone to help hold the fort. And some of the people and the projects. Would you move out to Melbourne with 2 weeks' notice and sort of be involved with it? And I remember thinking, well, I'm not really sure about this. It's sort of it sounds like a bit of a left field move, and I always remember my mum saying that don't mining sounds terrible. Stay in a nice safe job in the city in London, and it will be okay. And fast forward, I took the job, and actually, the guy I worked with most closely in Australia, Richard Evans, his career in the mining industry, early 50s at Western Mining, that was bought by BHP. And he's one of the co founders of Elemental with me. And, I've known him now for 11 years. And, I think that technical experience and background and network has been really helpful. And it's funny, the small decisions that can have a huge impact later in life that you
Yeah.
didn't expect them to. And I really enjoyed my time in Australia, and I came back to the UK, and I actually in my spare time in Australia I took on a shell company in London. It was effectively almost insolvent, and it had no assets. I wasn't paid anything, and I was keeping it alive in my spare time while I was working in Australia. But what it did do was I thought it gave me the opportunity to try and put a company together. And looking back on it in retrospect, um, I think you'd probably say there's diving in at the deep end, and then maybe there's almost foolhardy. And
Yeah.
this was a real stretch. And looking back at it now, I didn't have the best contacts, the best network. I'm trying to put this together, but we did actually get really good project X Rangold in Northeast Ghana, and took it to list in AIM. Long story short, mid 2014, when I came back to the UK, I still wasn't, I don't think, really being paid anything for it. But it was a really good sort of experience. And we actually had Endeavour Mining at the time. We're going to come in as a cornerstone shareholder once we listed it. And AIM regulation in London said, well, we think you should be an investment company under London Stock Exchange rules, not an exploration company. So redo the prospectus and apply as an investment company. And that was, it was a very long and tedious listing procedure. I was the only employee in the company. And 2013, 2012, 2013, 2014, probably even 2015, 16 were really lean years in the sort of capital markets and mining space. And so I had seen the valuation of sort of our comps and our peers go from 12 million, 15 million down to sort of 1 and 2 million. And these were companies with people with track records, connections.
Yeah.
And I remember sitting there and thinking, I've done so much work, and actually I'm in a business model and in a sort of junior startup at a profile at a point in my career where the risk is 95% skewed against me. We need a technical success. We need to get lucky with market timing. And even then, if at any point in the next 5 years the markets collapse, we might still get diluted 90%. And I remember thinking, I like the mining industry and I like everything that I've learned about it, but actually the business model is not on the exploration side. Unless you have the track record and the contacts, I think, and the credibility, it's really, really tough. And so I remember thinking, well, that company I was involved with actually did a merger with another private company, and it did subsequently list on AIM, but it was a long slog for them. And I remember thinking, I should either go and work for a bigger company and bide my time and build my network, build my connections, or if I'm going to start something again, I want to make really, really sure, I'm actually working hard and I'm working intelligently. And the royalty model within the mining space was the one model I thought that was my best chance. And I thought, if we can get a private royalty company with revenue and actually, cash flow positive, you give yourself an element of independence from the market and, the position of 2,000 other AIM or exploration juniors. And so that's how I came from being a history graduate to taking a job with a uranium exploration company in Australia, and then a Shell in London, and then starting a private royalty company. And there were probably times when I wasn't sure if I'd made the right decision.
Mm-hmm.
And you doubt yourself, but looking back on it, it's actually been wonderful experience and a lot of hard work, and definitely some risk, but enjoyable.
Okay. Yeah, you said a lot there, and I want to break down a few points. Let's start with the first one. Is I want to understand your mindset there, because your mom said don't go into mining, and you jumped into the deep end real fast. So what were you thinking at the time? Like you just said doubt, failure. I'm sure you felt both of those at the time, but you did it anyway. So why do it that way? Why not start?
Yeah, well, funnily enough, the job I actually went to in Australia, that was the almost the least risky part of it. So that's what got me hooked in, and that was a company that had recently listed. They had a uranium project that probably would have been a satellite for Paladin's Kailikira uranium mine in Malawi, and it was good people, a good project, and that was sort of what got me hooked in, and that was probably less risky in some ways to what I then did, which was take on a shell company. And I think my father's always been quite entrepreneurial, and I think maybe I got a little bit of that from him, and I probably I wanted to try and build something and put it together, and it actually I was really lucky, I think, in some ways, that exploration company didn't list, because if it had at the time, I would have felt obliged to stay with it and see it through, even if the market conditions were terrible, and I had to do it. Whereas it gave me almost that scar and that experience early on, gave me the perspective to sort of remove myself from the picture and take a 30,000 foot view and
Mm-hmm.
say, hang on a minute, this is not if I sort of really sat back and strategically thought about my career, an exploration company, is not best suited to someone in their mid-20s,
No.
trying to raise high risk venture capital money, without a track record to sort of lean on and a contact and network base.
So next point, which you just finished off with nicely, is you weren't born into mining. You kind of saw an opportunity and you took it. Now that you've been in it for quite some time, the industry, what are your thoughts on the mining and resource sector?
I think it's incredibly, it's got wonderful end on one side, and it's got another sort of side. It's got two extremes. It's got
Yeah.
its wonderful wealth generation extreme, where just in the last 2 years, 3 years, I can probably think of Chalice Gold Mines in Australia, who had the discovery in WA there. Rupert Resources in Finland, fantastic discovery, gold discovery. Great Bear Resources, obviously, in Canada, another great discovery. But there are three companies that went from being $10-20 million market cap to 800 million market cap in a very short period of time. And that is not just, fantastic for investors and everyone involved in the project, but it's fantastic for the communities, for the countries, and I think it showcases all the best parts of the industry. But then, the challenge is on the other side. You've got maybe 2,000 TSXV listed exploration juniors, 1,000 on the ASX, 200 in London. When you put it like that, you've got 3,000 companies. Your odds of success are quite low, and it's very hard to pick the right ones. And so I think I really I enjoy the mining industry. I enjoy the breadth of experience you can get. It is incredible the differences between a project up in Nunavut to something down in the middle of South Africa. Completely different landscapes, cultures, people, and that's really interesting. And I think it has a lot to give. And I think maybe mining in the 21st century will actually have a really positive reputation, which would be a nice legacy. I think, given in the past some of the probably negative publicity that the mining industry's, attracted.
Mm-hmm. I agree. Okay, let's get into Elemental now. Why don't we start with the origins of Elemental and your partner, the co-founder of Elemental. Tell me how you two are how you two work well with one another and what skills you bring to the table. How are you guys compatible?
Yeah, so I think probably early on with Richard, I kind of had the discussion with him that a lot of the successful companies I've read about or seen have been often their siblings or their brothers, or they have that kind of relationship where they can be brutally honest with each other. There's a phrase, sort of radical candor. You are very candid with each other,
Mm-hmm.
and you have to be able to be quite direct. And you need to. It really helps. The better you know someone, the easier it is to be really direct and say, "Hey, I think it's a good idea. I don't think it's quite worked out. We need to adapt or pivot or slightly, focus more on this." And I've known Richard for long enough that and I worked with him pretty much the two of us next to each other in the office in Australia for a year. That I really felt like 10 years later we have that. And Rich was one of the things that I think got on with Richard, I think well on, was he's quite and he won't mind me saying this, he's quite cynical geologist. So, one thing I had noticed in the junior space is there is a spoonful of optimism. If you sort of take the Mary Poppins analogy, and that can be a good thing and it's needed, but sometimes you also need a sort of dose of reality to make sure that you're not blind optimism. And I think getting someone like Richard, who spent his year at WMC in Kambalda, Kalgoorlie, worked in Corridor Sands, a lot of well-known big projects there, and it was WMC, one of the biggest Australian mining companies. And I think having that career in mining, and then Peter as well, who was one of the directors when we were private, who's just a generation above Rich, also at WMC. and he was sort of leading in charge of geophysics when it was still really a nascent technology um, within WMC and then at Independence Group. I think having their involvement, it's really good because I can bring a lot of energy and a lot of drive, and I can work really hard. But that grey-haired technical experience and those scars from being involved with different mines and seeing where it's gone wrong is absolutely necessary. And I think it's you can get consultants in, but I don't think it's ever the same if you've got your own skin on the line and
Yep.
it's your own money you're putting at risk. And if we've got some really good technical people from the industry as some of our seed shareholders and involved from the very beginning, it was, I think, in our DNA that we're not going to blindly walk into a terrible deal because we've got too many people with really successful and good experience in the industry from a technical background that they will spot some of the fatal flaws. And that's essential because in a royalty company, you're looking at an awful lot of opportunities, and we've probably done 2 in every 100, 1 in every 100.
Okay.
So we've been really, really selective. And, how you choose between the final 5, a lot of that comes down to, analysis of the company, of the project, of the people involved. And the people involved is a really big one. So I think that's been really important. And, I think lucky in some ways that our paths crossed and, we got on really well since.
And what were you doing? Because you just listed last year, right? And you've been doing this for 5 years private, right? So what were you doing for the 5 years private, and why go public in the middle of a global pandemic?
So we did our first fundraise in start of 2017, and then we listed in mid 2020. And really, I think the idea behind it was that if you've got one royalty, you're not really a royalty company. And
Right.
having had that experience with a junior exploration company where you're looking to raise $2 million, your listing costs are $1 million. And then once you're listed, your overheads every year are $500,000. You're looking at it and going, there's not much money going into the ground here. And that's going to reduce our chance of success even more. And then as a small management team trying to keep it lean, you don't have the bandwidth to spend the time on the things you should be doing. And so we said, what we want to do is we want to have a private royalty company that enables us to keep our costs really low at the beginning. It's cash flow positive from day one, so we have producing royalties from day one. And by the time we come to market not because we have to, but we come to market because we choose to, and because actually we think it's at a time in the company where we can hit the ground running and absorb all the extra work that comes with being a listed company, but not let it divert us from our business, from actually what we do that adds value. And so beginning of last year, with the acquisition of the Wang Yon royalty, which is Teranga, now it's Endeavour, but it was, it's 175,000 ounce mine last year. That acquisition felt like the right time to take it public. And so that was really the driver. When we listed, we were really, really clear with our investors privately that we would not put a timeline on listing because we did not want to be held to an artificial timeline. And that was dual-edged sword, because on the one hand, it meant we got really good quality investors who liked the story and didn't need to get out in 2 months' time. But on the other hand, it was a very small pool of capital. And so what it meant was, there came a point where we were at the right size, and also to do the next round of deals, we needed to be public and have access to capital markets. And so those two things sort of dovetailed in with the Wang Yon acquisition and the listing last year.
And how did the pandemic affect you? Because you say boots on the ground or get it running, but really you're kind of tied to your home for the first half of or the last half of the year, right?
Yeah, I think I think maybe sort of from April 2020, we were sort of really sort of getting into the guts of the listing process and starting the roadshow and that kind of thing. And I would probably have been in the same chair in the same room on the same laptop then. And it was an odd experience because I think I'm based in London, and sort of the core management team is based in London, and we've got some directors in Australia and in Canada. So it's an odd experience listing
Hmm.
into a new market, and you're pitching to people for the first time on Zoom. And for a lot of people, we were one of the first companies pitching sort of on Zoom at the beginning of the pandemic when it didn't feel normal, and so it was an interesting experience. But actually, I think at the beginning it worked really well, and it enabled people to be really efficient with their use of time, and we could do an awful lot of meetings in 1 week. I think in the early morning we had Hong Kong, Singapore, Australia. In the sort of midday we had Europe, and then early afternoon Toronto, East Coast, and late afternoon, evening,
Right.
West Coast. So it worked really well there. And I think it was just, as time goes by, the challenge is that you only really do a listing and a big roadshow once at
Yeah.
the beginning, and then the problem is you're sort of isolated a little bit and siloed over here, and you can't get to meet people. And I think if you're already listed and COVID happens, yeah, it's a little bit easier because you've already established all those relationships, person to person, face to face,
Right.
and so it's easier to call people up and do things. So I do think that it will be really beneficial for us when we can get over to North America. The sort of the beating heart of Vancouver and Toronto, and meet people face to face and
Hmm.
introduce the company for the first time.
That makes sense though, that you level, it's kind of a level playing field because everyone's resorting to remote pitches, so it makes sense. I like this is why I like starting this podcast, is to talk to people, because you're a young looking man, you are a young man. And what I've noticed though, since doing these interviews, is that the royalty space has actually a lot of young CEOs. And I was just wondering, like 45 and under, I'm thinking in my head, like they're relatively young people. So your thoughts on that? Why is there so many young professionals in this space?
Yeah, we there was actually a panel the other day, and there were maybe three sort of mid-tier royalty companies on there. So maybe Elemental up to sort of $1 billion market cap, and there were three or four of us on, and probably all of us in our sort of mid to late 30s, I think,
Yeah.
just about probably. And it's a really interesting point, and I think part of it is you go back to 2006, and the royalty space was $6 billion, and it's over $50 billion today. And that creates opportunity. And I actually think it's often, if you're younger in your career, it's easier to take that risk and set up a company and take that leap, because maybe you don't have a family, and
Yeah.
you're not as tied down. Whereas I remember talking to someone and in Canada, and he actually came very close to setting up a royalty company a few years ago, and in the end he said that one of the reasons he didn't was because, yeah, he had a mortgage and he had a family, and he was 10 years 15 years older, and he sort of said, look, I'm in a solid job, I'll be quite successful here. It's a huge risk to leave that and
Yeah.
turn it away and do something else. So I think that is partly it. It's a fast growing area within mining, so that creates opportunity, and then also the fact that it is in the mining industry. It's relatively, it's not new, but it's certainly newer, and
Hmm.
in some jurisdictions and countries it's not nearly as common as others. And so again, that gives opportunities to maybe agile, nimble, younger people who can come in and sort of seize it. And I think it's definitely a noticeable factor. And I am on the committee of young mining professionals in London, and there's chapters in Canada, and recently we've spread out and got some South American and Australian. And it's actually we have an awards every year, and it's held typically at PDAC, and it's for someone under 40 who has outstanding achievement. And actually, one or two of the problems or challenges we had is finding really successful geologists and people with a technical background under the age of 40, because it's not easy.
Hmm.
And actually, you look at the tech industry, and everyone's in a hoodie and starting up a tech company or a fintech company, and they're all younger. But in an industry like mining, a lot of challenges, and you need that grey haired experience. It's hard for a person in their 20s or 30s to raise $10 million and
For
go and
sure.
drill out a project in wherever it is, and get that kind of get that. So I think it's interesting to see that the royalty space is probably one of the only areas in mining where you have an age demographic similar to maybe tech companies or startups in other industries.
Yeah, that makes sense. And I agree. You're saying that the royalty industry is a relatively new space, and I agree with you. But a lot of people are saying that it's a relatively competitive space now. So you were talking about the issues with the mining industry. Do you care to? What are the biggest challenges in the royalty industry right now?
I think it's the royalty industry. You can almost separate it into two strands. You've got creating royalties with existing companies, and a company doing a royalty or a stream is always looking at it cost of capital versus raising equity.
Right.
And so when the equity markets are good, that source of royalties and streams, it can dry up a bit because people are going, well, our share price is higher than it's been in the last 2 years. If we're going to raise money, we'll do it via equity. And a lot of investors have made money in the last 2 years. And so they're going, well, hang on, I'm willing to put some more in. So I think that is often the case that royalties and streams, there are more opportunities on the corporate side when the markets aren't as good, and when actually royalties and streams are much more attractive, non-dilutive form of capital for companies. And so that's, I think, one aspect to it. The fact that markets have done well over the past 2 years on the whole, first for precious metals and now for base metals as well. And then I think also there's, as you say, there's probably been almost a dozen new royalty companies in the last 18 months. And the last time this happened was sort of 2010 to 2013 period. And actually, out of all those new royalty and streaming companies, then there's probably only one that's still around today, and the rest were acquired in M&A. And the big guys, the Francos, the Royals, the Wheatons, they were there, and they all acquired different royalty companies. But of the new of those 10 or 12 that started up in that period, only one sort of came all the way through, and they themselves acquired one or two other royalty companies. And it's partly because the royalty business model is very scalable. If you take a mine in Peru and you take a mine in South Africa, there really might not be much in common.
Mm-hmm.
And you're working in two different legal jurisdictions, two different languages. There isn't a lot of synergy, time zone or anything. Whereas if you're a royalty company, it's actually a strength to have one royalty in Peru, one in Chile, one in Australia,
Right.
one in South Africa. Diverse, because you're not operating anything, diversification is really beneficial in risk mitigation. And so actually for royalty companies, you can scale it quite easily. And as you scale the company, you get a lot of value add from it. And so that's an interesting area where I think there might be some consolidation in the royalty space over the next year or two, particularly in the 2 billion, sub 2 billion sort of
Right.
bracket, because probably some of those companies are looking and going, well, if we marry together, we're actually going to have better margins, and better opportunities. I think it's always then a trade-off of what are the opportunities for the company versus the value and the share price, and we can be able to add more value to shareholders independently in the short term or together. So those will be some of the questions, but it's it's definitely a good space to be in, because I think things can move relatively quickly, and there's always opportunities out there. And I cannot tell you how many times when we started this, we raised $1 million in our first round, and at $1 million as valuation. And I can't tell you how many times people said, you won't be able to find producing royalties. You certainly won't be able to find producing gold royalties. And if you fast forward to today, our biggest differentiator is that we're 80% plus producing royalties and producing gold royalties. And actually, to get a portfolio like that, to get the revenue that we have, you have to go to sort of $500 million plus companies. And so, I think today in every aspect, we're better positioned than we were when we started. And there will always be people saying you can't do it.
Mm-hmm.
And there's the 25-year-olds out there. But if you take some sensible advice and you have the benefit of, I think, being able to be honest with yourself and say, is this actually a good idea? And I did history. So before I went into the royalty space, the one thing I did is I researched every royalty company there was. And I researched those royalty companies from 2010, 2015, and what happened to them, and how, if they were successes or not, and what were the good characteristics and the ones that weren't so good. And my biggest takeaway was good quality assets and revenue are the two most important things. And if we can get that in our portfolio from an early stage, we set ourselves up in the best possible way. And I think it's taken discipline, because we only have 9 royalties today, but those 9 royalties are actually assets that would sit comfortably in the portfolio of an awful lot of the big royalty companies. And so I think that's where our biggest strength lies, actually, in sometimes being disciplined enough to say no, even when short-term pressure on you is sort of telling you to do it.
Right. Well, let's get into that then. How do you stay disciplined and competitive? Because that's where you lose the discipline, is when you're not competitive and you're looking at near-term producing mines. So these miners, they're going to go to 10 different royalty companies and say, what are you offering? So how do you actually remain competitive and disciplined at the same time?
I think it's definitely a challenge, because you always have competing pressures.
Mhm.
You have the pressure saying do the deal, and you have the pressure saying, well, we want to make sure it's a good deal and it's one we actually believe in. And so I think it's sort of, you've seen it once you've seen enough deals, you get a pretty good feel for where it sits. And most of the royalties we have bought have been outside competitive processes, sort of bilateral deals where we have sourced, found, and agreed terms. And a lot of those we were pretty comfortable that we were getting an excellent deal where, frankly speaking, we could probably turn around and sell it, you know, on good terms down the line if we needed to. But there have also been ones where we looked at it and said, scale is important. And actually, some of the feedback we got when we listed, and we were listing at a sort of $50 million valuation or so. And some of the feedback we got was that you've done some really good value deals, but you need some scale and critical mass, because I'm an institution and I can't invest in you unless you've got $500,000 a day of liquidity and you're 100 million plus market cap. So, try and blend those two. And that's what we said we would do from the listing. We said, look, we'll try and do those opportunistic deals where we can find good royalties that will actually have more value in our portfolio than they will in maybe their non-natural owners' hands.
Mhm.
And we'll also occasionally stretch for those big deals where we think this is going to really transform the company and put us in a different position. And if you can put those together, the aim is that we get that really nice blend of value and scale and critical mass. And it should be the sort of optimum one. Because the danger is, if you go too much for scale, you're never actually really adding value. You're just getting bigger and
Yeah.
everyone's getting diluted in the process. But if you just go for value, then, as you say, you end up not being able to sort of scale up enough. And actually, maybe some of the bigger companies will then take you out before you've had a chance to really build out the portfolio and sort of build on all the hard work that you've done putting it there. So there is a line, and I think you're constantly having to ask yourself, and this is one of the challenges, constantly having to ask yourself, are we doing the right thing? And market conditions change, and all of a sudden you're asking yourself the same question again, but with, maybe it's a slightly different answer. Maybe, okay, we do need to slightly change tack, because the markets have got a lot worse and there's more opportunities here and we can go and get those, and thinking about it. But I think that one of the important things is network, and haven't been able to do it, person face to face as much during COVID, but network's key. And certainly for me, I learned a lesson early on, that stuck with me, which was, good people tend to introduce you to good people, and actually, I think that's been true throughout my career. and been lucky to work with good people, and they have introduced me to other people who have been really helpful and who have been successful in their careers. And I think that's something that I would that's benefited me, and I'd mention as well.
Mhm. Thank you. That was in depth. Appreciate it. So history major, you look back in the past a lot, and you've seen that a lot of the successful royalty companies started with third-party royalties, right? Now, are you only going to stick with third-party royalties, or do you see yourself doing stream creation? Or one thing I wanted to ask some guest, and I'll ask you, why don't royalty companies acquire prospect generators? As isn't that a smart idea?
Yeah. Okay. So I'll do the first part. Yeah. We've done mainly, well, all third party royalties.
Yeah.
Now we're going to look at originating. And actually, when we listed, when we were coming to list, and we were starting start of 2020 before COVID hit, actually the market was not nearly as good as it was. And it felt like for a short time we would almost be the belle of the ball listing, and it was a really good time for a small new cash flowing royalty company to be listing. And then all of a sudden the gold market took off,
Yeah.
and there was a huge number of financings last summer, and actually what it meant is that a lot of the companies suddenly didn't need to raise money through a royalty. Now maybe if it's Franco Nevada with $500 million, that kind of size ticket, it might be something. But the kind of size deals we were looking at on the whole, most companies didn't need to do it. And one of the big risks for a royalty company in creating new royalties is your success rate, because companies do not need to do a royalty. So they might always ask what a royalty or stream would look like,
Mm-hmm.
but it might only be 5% of the time they do it. And if you're competing with 3 other royalty companies in every one, and only 5% of them are going to turn into a deal at any rate, you need to do an awful lot of that to get a deal.
Right.
And when you're a small company, that's expensive and the opportunity cost is really high. And so, yes, we'll definitely look at doing deals, but I think we'll do it when the time is right, and when I think we're comfortable and confident that we're going to spend our time most effectively towards that. And the second question, second part of it, was around
Prospect generators.
prospect generators, and it's a really interesting. I mean, it's a really interesting point. Maybe you look at a company like Altius, and they're a sort of hybrid prospect generator royalty company,
Mm-hmm.
and there's one or two other examples. But I think one of the challenges has been is prospect generating has a very long lead time, and some of I think the sort of Sprott extended family are very keen on the prospect generator model because they have the patience and the discipline to stick with it, and they've got 20 irons in the fire. But what I noticed looking at it was I noticed that often private investors didn't have that patience. They weren't willing to sit there and wait for 5 years for a project to develop. And if you look at some of the prospect generators that have royalties, actually the only producing royalties they have are ones that they acquired, because even their successful projects are on a 10-year time frame, and so haven't made it all the way through. So I think there aren't well, firstly, there aren't that many prospect generators out there. There's a handful. And secondly, I think probably the characteristics of the management team and some of the shareholders in those companies is that they're very patient. And I think if you've stuck with it for 5 years or 10 years and built it up, it may be that you still see a lot of value you can create internally, because I think there are some synergies there. And I think actually sometimes some of the royalties within prospect generators would get a better valuation in a pure royalty company. And then it's a case of, well, if that is true, what is a fair price, and what companies and what assets and what commodities. But it's an interesting point, because there are some that I could think of that I think would fit that category. And it's maybe that will be something that happens as well.
Yeah.
In the sort of royalty and streaming and prospect generator space over the next year or two.
It makes sense. I think it would be good for both parties. Okay. I have so many questions for you, but
Mhm.
one question I really want to ask is why is Elemental so focused on gold? Why gold? Why like you don't have much exposure to silver, copper, base metals of any kind, really. So why gold?
Well, we've always we actually our first deal was a mineral sands royalty, and that's one we still have, and the sister royalty is actually in Cisco. Um, so it was an opportunistic acquisition, and it was we saw it and we thought it was a good asset that would fit well in the portfolio we're looking to build. But one of the things that I have found is that a lot of investors and a lot of money in the royalty space is almost generalist money that is looking to get some exposure to commodities, hard assets, and typically actually precious metals. And there's a lot more generalist money that wants exposure to gold than there is that wants exposure to nickel laterite or to manganese or fairly not esoteric commodities, but commodities that are quite niche and specialized. And I have heard as we've gone public, I heard last year on a number of occasions that from investors that look, I want some exposure to precious metals, and I don't know anything about Ecuador, and I don't know anything about this specific region of Ecuador, and there is a huge amount of country and asset risk with me with X miner, and even with some of the mid tiers that have 2 or 3 mines, that's quite risky, and you can
Mhm.
sink an awful lot of capex and cost and risk into these countries. Whereas with a royalty company, it feels like an investment that gives me leverage exposure to precious metals. So it's better than holding the physical, but it will be more diversified. And because it's top line revenue on the whole, it will be lower risk than individual miners or sort of the mid tier mining companies. And so within that pool, a lot of the money is focused on precious metals. And so if you are, call it 70 or 80% precious metals, that's almost the I think the sort of the marker that a lot of the big royalty companies have is that kind of unofficial rule that we'll stick to this weighting, and therefore will always be an asset class for them, but we can get exposure to other assets. And for us, we've always looked at non-precious, but very conscious that as a smaller and newer company, we need to keep a really strong focus on precious metals. And if that's what it says on the tin, we want to make sure that we're sticking to it. So we will look at other commodities we have, and there's some really interesting opportunities we've seen over the last couple of years that are still out there in the non-precious space, but we'll be quite selective on those. And so if we do something that isn't precious, it has to be a really good, compelling reason, I think, to do it.
Thank you. That was a good answer. Now, a lot of these generalist investors, they're gold bugs, and they believe that this whole world of debt's going to collapse one day. But debt really helps you accelerate growth in a company, and you guys have debt. So I just wanted to ask you, are you looking at renegotiating the debt at all? And on top of that, when you get material cash flow, do you still plan on using debt throughout your company?
Yeah, so it's a good question, and for context, maybe a bit of background for everyone. The deal we did just before we listed at the start of 2020, a $12.5 million acquisition on a producing royalty, and we used $8.5 million of debt. And then when we listed and we started trading, so about 7 months later, we repaid that debt, and it essentially allowed us to close the deal before we listed and get going. But we kept those credit agreements alive. And when we did a deal with South32 at the end of last year that closed at the start of 2021, we used those same credit agreements and we did an enlarged $25 million US dollar credit facility. And that enabled us to do a larger deal with less financing at the time. And it also, and this was really important, it actually gave us the ability to sort of guarantee that the deal would happen. Now, that's something that I think is often missed with investors. But you talked about a competitive landscape in the royalty world. Well, you can imagine if you are a royalty owner and two royalty companies come to you, and one of them says, we'll buy your $20 million royalty and we'll go out into the market and we'll raise $20 million. And the other comes to you and says, we'll buy your $20 million royalty and we've got $20 million credit facility lined up that we can guarantee you will work on.
Right.
Well, they will always go with the deal that has less risk. You know, especially if it's a non-core asset or it's something not material. You know, no one wants to go through the pain of a deal not working and renegotiating and it falling apart. So having access to credit facilities is really important. And then I think it's a case of how you use it. And for us, we were at a point where we were, I think it was a pretty transformative acquisition that we did in terms of the size and the scale and the assets. And so we used a loan from Sprott Lending in Canada, who we did the previous loan with, and they I think have actually been really helpful for us in enabling us to do one or two really meaningful transactions. But the cost of that was it's 9 plus 1%, so it's 9% plus LIBOR 1%, and so it's relatively expensive in the short term. And that's a 6-month to 2-year term that the loan has. So anywhere from sort of end of July onwards, we can refinance it, we can repay it, we're free to do what we want at no cost. So one of the things that I think you have seen one or two other sort of royalty companies do quite successfully is as they've grown, they have been able to graduate to credit facilities with some of the bigger banks. Mm-hmm. Now, actually, you know, no startup royalty company has done it in the last decade, but no startup royalty company has got to $10 million sustainable revenue in the last decade. And that's the position we'll be in come Q3. And so I think actually with our biggest royalty, Carla Winder, just having first gold pour at the end of June in Australia, that adds another $4.5 million of revenue a year with a 10-year plus reserve life. So it puts us in a position where we can graduate onto the sort of credit facilities with the major Canadian banks that I think marks a really significant turning point in the company. Because at that stage, we're starting to tick more of the boxes of a mid-tier royalty company than a junior royalty company. And you know, again, there's no sub $500 million royalty company that's done that today. And so for us as a 100 million market cap, if we can actually tick those boxes, it means an awful lot, because it gives us a flexibility going forwards to be able to close transactions with certainty. But of course, it also reduces our interest cost on the loan. So really important for both of those. But I think that being able to access credit facilities is a sign of the maturity of the assets in the portfolio. And I think that there are not many junior royalty companies that could do that. There certainly isn't anyone sub 500 million market cap who could do it. So I think these are things that over the next sort of 3-6 months, the rest of 2021, if we can tick some of these boxes, I think it really demonstrates the quality in our portfolio and the unusually high cash generative nature of it. You look at the royalty model and you know it, we've been talking about it now. Yep. It is a highly scalable business model. The space has grown from 6 billion to 50 billion. There's been $2 billion of deal flow a year on average over the last decade. So there is an awful lot of growth. For us as a 100 million market cap company, we only need to capture a very small part of that to be meaningful. So we know there's growth out there. And the question is, okay, you've got all this growth and upside, which you, Fred, the CEO, are going to sell me on because you believe in your company and you've built it from scratch. So you're always going to believe it. But what's the downside? And the downside with most of the junior royalty companies is that they don't have any revenue, or they have minimal revenue. And if the markets go bad, they have to dilute almost like an exploration company. Right. And actually with Elemental, we've always targeted $10 million of sustainable royalty revenue, because at that point, our overheads are covered 5 times. At that point, we're actually going to be cash generative, every year. And so we decide when we want to raise money, we decide what deals we want to do, and we're in control of our own destiny. And I think that's the big difference. It's that asymmetrical risk profile. We've got some of the characteristics of the big royalty companies, diversified cash flow, but we've got the growth potential of a junior. And marrying those together is what makes us unique. And it is what I think really differentiates Elemental as a company in the royalty space.
Yeah, it's very exciting. Very exciting story. Thank you. You went in depth with a lot of questions. I had a few more, but I respect the time because I still want to get into the vault. I really enjoyed this conversation. And if you guys did, just make sure to like and subscribe. The vault will not be available on YouTube, just Apple Podcasts and Spotify. I'm just trying to get my subscriber count up, guys. So subscribe. Let's get into the vault.
So I would, if I was younger and I had 2 job offers and I was in my mid-20s, and one was paying me more, but maybe in a company that hadn't been so successful, and the other was not as well paid, but it was with some really great people.
Yeah.
With the benefit of hindsight, I would absolutely go for the company with the great people and the great management, because I think you will end up getting a lot more out of it in the medium and long term than you will in the short term.
It makes sense. That's why I started this podcast, and no money coming in, but I'm sitting down and asking questions I want to. I invest, and it's made a huge difference in my personal portfolio. So that's all that matters to me. And I sit down with great people like you, and it it's definitely worth. It's not always about money, for sure.
Yeah,
Thank you.
it's
Thank you,
much
Fred.
appreciated.
I appreciate this. I appreciate your time. I know it's late there, but I do like letting my guests close off. So here's your chance. Just say whatever you'd like to the listeners out there.
Well, I think one thing we would like is actually, and we always enjoy, is if there are any shareholders who are listening, or even investors who are curious, actually really do enjoy hearing from you directly. And sometimes we feel a bit siloed in London, especially in lockdown. So we always try and say, if there is anyone, please feel free to get in contact. Call us, email us. It's actually really enjoyable for us too sometimes to hear from shareholders personally, and to get their perspective from the outside on what they see and how they're seeing it. So just anyone, feel free to reach out to us at all times, and hopefully we'll get back to you as soon as possible.
Perfect. Thanks, Fred. Thanks so much.
Thanks, Carl.